Okay, we're going to get started. Problem when you have these programs, after everyone leaves, first thing in the morning and the second day. But thank you for staying, everyone. And we have a very strong panel for you today. My name is Ron Feldman. I'm the founder of Franchise Strategy Solutions, amongst a number of other things. I've been around franchising for about 30 years, mostly as a lender. To my left is John Goldisich. Want to go ahead and introduce yourself, and we'll go right down the row.
Yeah, thanks, Ron. John Goldisich. I'm a managing director at Lazard. Lazard is a global investment bank, and I lead the restaurant and franchising practice. Lazard, as an investment bank, what do? We advise companies on mergers and acquisitions and raising capital. We're an advocate for companies. We're their representative in the market when they are looking to optimize their capital structure, recapitalize the business, change ownership, or sell their business.
John?
I'm John Sparrow. I'm the CEO of Go Oil. We're a startup that started in Winnipeg, Manitoba, and we built a mobile oil change company to service companies like Amazon and U-Haul and all your rental car companies. We bootstrapped and then we raised venture capital, so we have the experience of raising from investors and stuff like that.
And I'm Grant Marks. I'm a partner with the Riverside Company. We are a global investor in a whole bunch of businesses, but I lead our franchising practice, where we've partnered with more than 55 franchise brands, all franchisors focused on particularly the emerging end of the franchise economy, really focused on services, and yeah, that's it.
Thanks. So before we get into the conversation, how many founders are in the room? Cool. How many founders still own 100% of their company? Oh, all the founders that's great. How many private equity folks do we have in the room? Just one in the panel? And others are, I'm assuming, either suppliers or franchise or employees? Yeah? Did I miss any job titles? No? Good. Okay. Well, for the founders, I think you're going to get a lot of value here on all kinds of tools that you can use to help scale your business. We're going to start by kind of going through what the options are. I call him by his last name. I got John G and John S. So I'd say, Goldisich, why don't you take it away and just go through real quickly what the options are.
Yeah. So there's a lot of different pockets of capital, right? The main two groups, as you know, is debt and equity, but it's a significant spectrum. So, on the debt side, you can go to your local community bank. You can go to a commercial bank. You can raise a private note with high net worth individuals or people who are willing to lend you money. We'll talk about it a little bit further in the panel, but there's a large pool of capital called private debt, which is non-bank lenders as well. So not your Wells Fargo of your bank or your Bank of America, but investment firms who are strictly in the game to lend money to businesses on a basis that's not regulated by the FDIC. On the equity side, again, it's a wide spectrum. You have venture capital for early stage and seed investments. John will talk quite a bit about that. You have growth equity, which is where it's essentially private equity, but in a non-control position in the business. And typically, growth equity is less about the proceeds that are coming out of the business to the founder. And more about primary capital that's going to rest on the balance sheet to be used for various growth initiatives within the business. On the control side of the spectrum, you have traditional private equity as well. And the main thing that I would emphasize there for all of you guys is that in a lot of these emerging conferences with early stage franchisors, people talk about, you know, private equity does this and private equity does that, like it is one thing, it's one commodity, and it's very much different. And Grant will talk about that as well, but you know, the dollars that private equity investors invest, that's the commodity, but the people that you're partnering with are all different. They have different risk tolerances, they have different worldviews, they have different industries that they go after, they have different value add that they can provide to your business, you know, strategically or through board governance. And so, you know, if there's one thing that I would leave with you guys early in the panel today is don't think of private equity as one thing. It's very, very diversified. And then, you know, there are other forms of equity, you know, just in terms of different securities like preferred equity and structured equity and things of that nature. But just think of capital as a spectrum along the risk and the return spectrum.
Yeah, all money is green. I learned that a long time ago, at least in the U.S. But it comes with different terms. And the terms are the things that you founders really need to understand before you leap into doing any type of transaction. So, John Sparrow, your story fascinated us on our pre-call that we had. And why don't you just give us the short version of how venture, because I've never seen real venture capital the way his company is capitalized in franchising. And it seems like there's a trend happening. And I think you're on the leading edge of it.
Yeah, I mean, we were, you know, we bootstrapped the first couple of years of Go Oil. We expanded in Canada. We were in a startup accelerator because we have a lot of technology behind our company, and we kind of think of ourselves as a tech-enabled service brand. And you know, we were meeting with some high net worth individuals, and happened to be the co-founders of Hootsuite, which has built a massive company out of Vancouver. And you know, we're sitting there, and I'm just like, you know, I'd really want to go to the U.S., but like, we're not a traditional like tech company, we're not a traditional anything. And they're like, no, when you pull everything back, you're very much like a royalty brand, and you're kind of like a SaaS, but not a SaaS. And we ended up like putting together our first round, kind of like as an angel check. And the difference is that it's a high net worth individual that's like, hey, I like this company, kind of want to take a gamble on this person. We did a convertible note, meaning that, you know, they invested $300,000 on the expectation that the company be worth a minimum of $2 million in a couple of years, and they can either convert to equity or we can pay them 3 times their capital back. So it's expensive terms, but no banks or anyone at the time were lining up to kind of fund us to move into the United States. First check was able to do that. We're able to push in the U.S. You know, we've sold over 408 units now in the U.S. So that capital was really important. So we went from like 12 franchise units in Canada to skyrocketed amount of franchises in the U.S. We ended up doing some follow-on. We call it seed investment, which is almost like a pre-seed round. The terms don't really matter until you get to like a Series A or a priced round. There's tons of books on venture capital and how it works, but pre-seed's kind of like you have an idea, you kind of shown some kind of traction. So that's what we're able to do with the 12 units we had in Canada. Then we're like, hey, this is more of a seed round. We need to raise a couple more, you know, at least $400,000 more. We're going to do these 3 or 4 things. And we've only raised capital in non-operational support. So when we were raising from these investors, we're like, we're not bringing in this capital to support our operations. We're bringing this capital to do growth things. So we've always done it that way. Not all startups can do it. And then now we're raising a more, we'd call it a more of a senior seed, but we're raising a $5 million round now to help us push into some European markets and finish out some of the United States. And that's, again, growth capital, not necessarily operational capital. But that's in short kind of how we've looked at this venture capital side.
And the thing that blew me away is, how much of the company did you give up for this?
So
seeder?
as it sits today, I still own 100% of the company. We raise this on convertible notes. And so what that is basically, we haven't converted any of the notes yet. We haven't had any actions to actually convert them. So today I sit here with the option to buy out the initial investments at like 2.3 million roughly area, plus the interest. There's about a 6% interest a year. If every year we don't convert, there's additional interest, but 6% right now interest rate is extremely cheap. And we'll likely lead towards buying out the convertible notes eventually, or we really like our investors, and if we do convert it, we're looking at under 15% of the company that would be given up. So you also have to remember who was an investor in you and kind of believed in you in the beginning. So it's a balancing act too, right? So you got to do what's best for you and the company, but also they come with strings and connections, and we're there for you. So it's a fine line to walk, but definitely the way we raise venture capital, we have 3 or 4 different options. So.
And if this kind of financing is actually coming into franchising, I think it's a really good thing. I don't think if it comes into franchising, there's going to be the 3 times liquidity out that he has, because I wouldn't do that if I were putting the money in. So, and we were all talking in our call, like, that's a sweetheart deal you got. But it's cheaper than bringing in, the most expensive capital you can bring in is equity, because it doesn't go away, right? So he's got optionality that you wouldn't have otherwise. Speaking of how much people need to start, of the founders in the room, how many started with more than $1 million? I knew I'd get no answer to that one. Okay, how many started with less than $100,000? Was that enough? Ray, keep your hand up if that was enough. For 1? Okay. 2? Good for you. We had this debate on our prep call, about how much it really takes to start a franchisor business that can actually scale. And we had different numbers we threw around. You raised $300,000.
That was our first check, yeah.
And that was to come into the U.S., write an FDD. You didn't have an FDD here.
Yeah.
You had to do all those things, but you had 12 units operating already. Grant, as somebody who's invested in, you have 55 current, but you have had hundreds, literally.
Yep.
I mean, Riverside owned Neighborly twice. They
2.5 times.
2.5 times?
Yeah.
Right? It wasn't Neighborly when they first invested, but I mean, they sold it and bought it back. So, what do you think? You've seen brands of all size. What do you think the right number is?
That's a exogenous, $3 billion company. We've also incubated concepts, and so we've effectively launched, franchisors. And I would say it always costs more than we think. Particularly in certain circumstances where we've launched concepts that require regulatory hurdles. So we launched a concept called Boost, which is in the home health space. It's Medicare reimbursed, and just the legal fees, the cost of marketing the brand, telling the story, getting out in front of brokers. It all adds up. I don't know if there's a way to put a number on how much it costs, but in short, it always costs more than we think.
Yeah.
In the prep call, the investment banker answer was, it depends. So what I said was, it depends on what type of system you're in. It depends on what type of industry. Look, franchising is a business model, and it applies to a lot of different industries. It applies to restaurants, to resi services, to business services, to industrial services. I mean, everything in between. And it's hard to put a number on what is the appropriate level of capitalization for your business. But the main thing is to be thoughtful about it and prudent about it, because the beauty of a franchising model is that at some point, if your system is happy and healthy and growing, your royalties are gonna surpass your SG&A, and you're gonna start producing a tremendous amount of cash flow, and you don't need capital. It's a very high cash flow margin business model. It's like the software industry. That's why there's so many private equity groups that love it. But it's really prior to that royalty self-sufficiency that you're going to be a capital consumer, if you're looking at entering into having a handful of a portfolio of corporate units, or you need to build out your tech stack, or you need to, go find that, really talented, C-level executive to round out your management team. All those things are going to take capital, and so you just need to be prudent about how you are capitalized before you reach that royalty self-sufficiency.
And if anyone has questions, just raise your hand and blurt them out. We don't want to, we want to have a conversation as much as possible. I think my answer was, if you have corporate units, it takes less. If you're assuming your corporate units are profitable and can feed the franchisor entity. If they're not profitable, you shouldn't be franchising. That's right. If you're not making money in the corporate unit, it's kind of silly to sell a franchise, right? But if you don't have that, if you don't have any corporate units, I would actually encourage you to open a couple before you start franchising and make sure that your business model works. You need to have a staff to support your franchisees day one. And I honestly, if I had to put a number on it, I'd say $300,000 to $500,000 at a minimum is what you would need to get going, and then you're going to need more. Now, there are things in the market now which we're going to talk about that let you outsource some of those high-priced employees that you don't have to hire, like franchise sales. But that all comes with a lack of control, quality control, that franchisors get enamored by the initial franchise fee in the emerging world. The people you say no to are more important than the people you say yes to. And I think everybody here should take that to heart. Let's talk about some of the pitfalls that we discussed. We kind of covered undercapitalized. John Sparrow, you mentioned overcapitalized. Tell us your thoughts on those that have too much money.
Yeah, I mean, in the venture space, we have some twins in our space. The one has raised 130 million. We have the same service network. None of us have any idea how that money was spent. We have another one that's raised 40 million. They're smaller by like a quarter of our current service network. So sometimes, like in the venture world, you get at these companies, especially in the US, that can just raise and raise and raise, and they'll go and hire and hire and hire and spend, because at the end of the day, venture investor, like a traditional VC, doesn't want to give you $5 million for you to have $5 million sitting in your bank doing nothing. That was a very bad investment. So you get a lot of these startups that will, get the money and spend it. And so you have to be really mindful of the money you take on. There's that expectation that it's going to be spent, and it needs to be like, it's hard sometimes for staff to see venture capital come into a company and go, well, let's put it away, but we need to turn that money around and grow as fast. So our competitors got into that trouble. Like they overspent, and they made a lot of mistakes, and that could have worked out for them, but so far it hasn't. But that's traditional VC. But yeah, overcapitalized, it can be a problem. You end up too high of staff. Like we have a team of 10, they have a team of 500. It's we're doing very similar things every single day. So yeah.
Growing too fast. I've been around this business model for 30 years, and the companies that grow too fast and crash are the ones that create the bad stories on Capitol Hill. I don't have to name names. We all know who a bunch of them are. Don't fall into that trap. Your SNO number can't be more than 4 to 5 times your ability to open every year. So, sold not open. SNO is the kind of acronym, but and that's something that as a lender we look at Apple Pie. So we actually look at what the ratio is of sold not open to how many they're actually opening. And if they can't make a dent in that every year, then we know that's going to be one that's going to crash and burn.
Ron, can you explain the 4 to 5 times ratio that
So-
you're describing to them?
Without throwing anyone here under the bus, you know, some of these franchise sales organizations are really good, right? And they'll sell 3 to 5 packs and collect the money for 3 to 5 packs, and you're going to end up with 250 sold, not open. But you only have the operational capability of opening 10 a year. And you don't have the capital, because you didn't raise it, to hire the people to open 30 a year. You don't have the money to hire Buxton to do a real estate study if you're a brick and mortar. You really want to make it so that you have the infrastructure to make a dent in that you don't want to oversell. My wife and I started in franchising as a Goddard School franchisee. We bought one license in 1995. We didn't open until 1998. And that's because it was a build-to-suit 2-acre piece of dirt that had to be found with zoning that nobody wants a child. Everyone wants child care centers, not in my neighborhood. So they don't want kids running around. Worse is doggy daycares. That's even worse. So you just want to make that ratio something that you can manage as a founder.
So,
Right.
so if you're building to sell, that ratio being way out of whack is going to hurt you in 2 ways. One, it's going to hurt your ability to raise debt from lenders like Ron. Well, I guess 3 ways. 2, it's going to hurt from an equity perspective, because we look at that ratio too and we say, hey, you know, they're not able to really fulfill the obligations of opening on a reasonable schedule. And then 3, if your number is really, really big, we look at it and we say, you've sold out, you know, 80% of the country, and where's our white space to go and develop? We got to eventually claw back some of those people who are sold and take some of those territories back and then, you know, resell them. So it's going to hurt you in a bunch of different ways if you don't manage that ratio well.
And to kind of pull that point forward, kind of to the next level, or the next step is, you know, there's a lot of franchisors too who will experience some friend dev success. And, you know, say they've got 40 units open, they hire a broker, an FSO, they get a large snow pipeline, they get, you know, another, you know, 40, 50, 100 units in the ground and operating. At that point, you see a lot of founders that just get stars in their eyes, and they're like, all right, now's when I should bring on, you know, a private equity group, or I should sell, or I should monetize my business, because I've done it. I've got these units in the ground. But what anybody who's going to be underwriting the risk of that business is going to look at it and say, you have immature franchisees. So your franchisees are not proven yet. You don't know if you have a sustainable system, a sustainable royalty stream, a sustainable group of franchisees who are happy and healthy and making money and want to continue to grow within the system. And so that's another thing that I always, you know, caution founders about is, you know, your franchisees are the most important thing. And, you know, just when you get those new franchisees open, that doesn't mean that you've reached the promised land, so to speak. Those franchisees have to open and then, you know, demonstrate to the market through verifiable data that they are sustainable and that they're not going to shutter their doors in 18 months.
So let's talk about the basis of franchising success. The whole lunch session, was it lunch? I don't know what time it was, but when Shane ran the panel yesterday with Sam Ballas, unit level profitability, unit level economics. If your franchisees aren't making money, stop selling franchises. Simple, till you fix it. Don't keep selling, because then you know who's going to make the money? Lane's litigator. Right? I mean, when franchisees don't make money, you're going to have problems. When franchisees are making money, the problems kind of go away. So your focus as founders, if you can't manage unit level profitability, then your first hire should be someone who can. Founders, are you collecting monthly financial statements from your franchisees? Anyone not? I won't make you start. You have to. And whether it's using Profit Keeper who's here or anyone else,
I was gonna say, better yet, use a technology that.
the technology's,
You don't have to ask,
technology's so
it's already
inexpensive, it's cheaper than you doing it yourself,
Yeah.
quite honestly. But I'm the one who kind of raised that question yesterday that everybody came back to me and said, no one ever brought that up. It's not about EBITDA. Even though I have a license plate that says EBITDA. EBITDA is a valuation tool. It's not an operational tool to manage the performance of any business. It's just a valuation tool because somebody's going to come in and recapitalize the company and then do a cash flow. What matters to your franchisees isn't even net income. It's cash flow. Because if your franchisees are borrowing money and taking short-term loans, then all of their cash flows go into the bank. So you don't want your franchisees working for the bank, you don't want your franchisees working for you because they're unprofitable, and you don't want them working for the landlord. You want them working for themselves. All right, I'm off my soapbox now. Corporate governance. When institutional capital comes in, what changes to the founder as, even if it's a minority, let's talk about minority investment and then we'll talk about majority. In majority investment, you're now an employee. That's just what happens. You have a boss and you have a board and the board can fire you, even though you started the company. So let's talk about minority, because that's kind of in the middle. And
John,
why don't you start?
Yeah, what he's done.
Yeah, my opinion, and I tell this to startups all the time, is like, just because you start the company doesn't mean you should be the CEO the whole time. Even your starting employees should not necessarily be with your, like the company, you go through phases. Like if you think of a business as a child, right? You start it, has diapers, you gotta look after it. Like maybe you're good at the infancy stage. But as the company grows, there comes a real question of like, am I the best person for the company to be spending capital on a monthly basis to lead this company, or is my COO the right COO at this time, and like that, and being open and transparent with your investors on, hey, I'm really good at running a company to this point, and then this is where I'm gonna start needing, to bring in some expertise, and then, maybe stepping back a bit. But yeah, that's my opinion. Is like I think everyone gets attached to their company like it's theirs, and they have a personal, almost like their company is them and they are the company. I think it's very important to separate yourself and realize they're two different things. And yeah, like at the end of the day, you got to look yourself every year whether you're the person to run it or not, and that's just reality. And you have more on the private equity side.
Yeah, I mean, it's kind of just what Ron said. We're investors, we're control investors only, and so when we come in, we do staff a board. We try to staff it thoughtfully with outside board members who are independent. We also have usually the sellers who are on the board with us. But we own typically 4 out of 7 board seats, and the reason for that is we have institutional investors. We commit to them that we're going to return their money on a 5 to 10-year horizon, and so we have to be able to sell and dictate when we're going to sell. And so that's the reason that most private equity is all structured kind of that same way. There are alternatives out there, obviously venture, kind of structured equity and the like, where there are non-control options that are out there. But those folks are all going to ask for board participation, board seats, and rights to be able to similarly make sure that they can generate their return.
Yeah, I've advised on a lot of minority recaps, which is a non-control private equity investment, and honestly, that's where a lot of the negotiation is in those deals. You're not just negotiating valuation and structure, but you're negotiating governance rights. And there's a laundry list of governance rights that an investor is going to want, and that their lawyers are going to paper. And that's where a lot of the back and forth goes. At a bare minimum, a non-control private equity investor is going to want board participation. If it's a 7-seat board, maybe they have 1 or 2 of those seats. you're still in control, you still run the day-to-day, you're still the majority shareholder, but you have another seat at the table. And if you pick the right partner, it's a value-added partnership. It's like a marriage. You've been able to talk to multiple different investors and pick the one that rose to the top in terms of who you want to be in business with. And some of those non-control provisions are really like major major changes or decisions in the business. Like, can you spend more than $500,000 in CapEx? Can you sell the business? Can you go into another line of business or materially change the line of business that you're in? And those are all codified and written in an operating agreement, and is essentially defines the rules of engagement where you and your partner are going to operate for the next 3 to 5 years.
So what if I wanted to raise $1 million in a minority equity deal for 10% of my company? What's that going to cost me in legal fees and banker fees?
I know from venture, so like a lot of venture lawyers, it's $5,000 each round. Doesn't matter. They have a flat rate, but the only deal is there's also in that legal agreement that they want to represent you for when the deals start getting bigger and bigger. So they do it because it's a cookie cutter. They use the same term sheet for all like 10 or 15 different types of investments. So especially on the venture side, it's easy because it's all the same safe agreements. Yeah, it's easy, but on more of your kind of stuff, it's more complicated than the venture side. So,
Anyone else want to venture a guess?
I won't venture a guess. I'll say it probably shouldn't be more than 5% of the cost of the deal. That's a general rule of thumb. So if you're raising $1 million, you probably shouldn't be spending more than $50,000 on all your fees and expenses.
I think that's a good barometer.
Yeah.
And then if you're hiring a banker, you're probably paying a little more than that. But if the banker brings you the right capital, it's well worth it. So just want everyone to have realistic ideas of where this is. Let's talk about legal and accounting professionals. How many of the founders here are using the same accountant that they had to do their last business, or just their relative, or is it a non-franchising specialty accounting firm? Anyone? I think that's something you need to look at. When you bring institutional cap, same thing with legal. This is put on by Fisher Zucker. They're probably the #1 emerging brand law firm in the world. I would probably be able to say that and be factual. They know this space. And when you want to attract, whether it's any of this capital, whether it's a minority investment, a majority investment, venture, your books and records go through a scrutiny that they're not going through now with you as the founder. I can probably, unless you're completely OCD. So can you, Grant, talk about like the worst set of books and records you've ever come across and what happened to it?
Well, we've had to like go back through P&Ls where we're like rebuilding the general ledger in like people's basements. So that's something that I've had to do. I've like literally had to go to someone's house and help them rebuild a P&L. May not have been franchise specific, but that's probably the worst story. So I would encourage everyone to think about at least getting your financials like reviewed, if not audited, once you get to a certain point, because like Ron was saying, if you're building your business to eventually sell, which most people are, or raise money, it's a financial proctology exam you're going to go through. So you're going to want to be well prepared for it along the way, so that when we're going through it and doing a cohort analysis of your 2022 franchisees, and you have all that data. So, like I was saying earlier, use a tech tool to collect that data, and start with tools that are affordable. QuickBooks is pretty affordable and easy, and everyone on this side of the table knows how to work with QuickBooks, and graduate when you can to something that's going to be more either industry specific or something that's going to be a little bit more data intensive.
Yeah, the best franchisors that I've worked with, the best in class franchisors who've gotten the highest valuations, they've all started from the very beginning in being very mindful of the data that they collect at the franchisor level and at the franchisee level. And so, even if you're just starting out and you have, 3 corporate units and you're just franchising and you've signed, 7 new franchise deals, don't wait to put in the infrastructure and the technology in place that can accumulate that data. Because if everything goes to plan and you get to a point where you're attracting capital, you're going to put a 5-year projection model together, and that's going to be the basis of a private equity partner or a new buyer, a new buyer's valuation. And they're not just going to take your word for it. It's not just hey, trust me on this. They're going to need to verify that your projection is appropriately risk, that they can apply a certain appropriate amount of risk to that and give you millions of dollars based on that projection. And so, there needs to be data that supports that projection. What data? It's franchisee level profitability. It's your sold not open pipeline. It's your lifetime value of your customer. It's your customer churn. It's your ROI on your marketing spend. There's a whole list of KPIs that they're going to look at. But the main thing, and it all comes down to the health of the franchise system. And so, if you don't have visibility into the performance of your franchisees, then an investor or a buyer of your business is going to assign more risk to your business, which means it's going to be valued less. And if you can provide very clear visibility into the underlying health of your franchisees, they're going to assign less risk to it, and they're going to value you more.
I've been underwriting brands for a long time. I open somebody's FDD. The first item I look at is item 20. Everyone here know what item 20 is? It's the chart of openings and closures, if you don't know. And if you're an emerging brand and we see any closures, we're going to question what happened, why did it happen, why didn't you buy it back, how did you let a unit close when you have 10 open? Now you have a 10% closure ratio, which is going to destroy your valuation, because that's the historical number that they're going to use. So when I open an FDD, item 20, that's the first thing I look at, and then if there's too many closures, I pass and I go to the next one. We're not going to lend any money to that brand. So I can't tell you how important, especially at the emerging stages, that you not allow units, territories, whatever, to go dark. Get creative, buy them back, resell them, do something.
Got a question?
Yes.
You made the awesome statement to stop selling if your location unit economics isn't working. I'd love to hear from Money what you guys consider to be working for location economics and how you monitor that. Is your return on investment, is it percentage free cash flow? Is there a rule of thumb for an emerging brand to shoot for so that they understand?
So I'll quickly answer. We look at the ROI on the investment for the franchisee and the time frame that it takes them to get paid back. And if that ratio is 5 years, then a franchisee should just go take a job somewhere else. And we're probably not going to invest, and probably not a lot of other investors are going to either. if that's the average for your system, that's a tough number. We look for, like, really good is anything less than 3 years. And somewhere between 3 and 5 is okay, and something that we'll consider. But where we're gonna get aggressive on valuation, to John's point, is when that ratio is like a sub 3-year payback.
Greg, is that cash on cash, or is that total investment?
That is cash on cash.
Okay, thank you.
Remember that cash on cash, they're gonna subtract the principal repayment. I keep getting on that.
Okay.
Doesn't flow through the P and L. It only flows through the balance sheet.
And I agree with everything that Grant said. The one thing I'd add is just that, and when Aziz Hashim was the president of the IFA, he would say this in his talk, but, you know, the other thing to think about is that put yourself in the franchisee's shoes. I mean, I didn't mention it in my intro, but I'm a franchisee as well of Hand and Stone and Orange Theory Fitness, and so I am a franchisee. I'm in those shoes as well. You know, oftentimes franchisors will get enamored with their you know, franchisee level profitability percentages. So, and you know, we our franchisees make 20%, you know, of you know, sales in profit. But one thing to think about too is just that percentages don't buy groceries. And if you have a low AUV, and, you know, that franchisee has put a lot of investment in it, and, you know, it's a $100,000 average unit volume, and they're making $20,000 and they're making that 20%, you know, that's not a sustainable income for them. They're gonna have to either double down and open up 6 more units, or they're gonna try to find something else to do to support their family and make a living. And so just think about dollar profit as well. And put yourself in their shoes and think of yourself as like, is this truly something that can support, you know, my franchisees as an investment, but, you know, also as, you know, the central earning, you know, vehicle for their family.
Absolutely, absolutely. All right, we're getting to the question that everybody actually walked in here saying, you know, how do I get a 25 times valuation and cash out and get generational wealth, right? Let's start with Grant.
Okay. Yeah.
Or
Well,
what causes?
Let me start by saying that probably less than like 0.5% of all franchisors have ever gotten a multiple north of 20 times. So, and so I would encourage everyone to level set a little bit. When you're first starting up, it's going to be difficult to raise outside capital until you get to royalty self-sufficiency. That's a general rule of thumb. It's not prescriptive. You know, obviously John was able to raise some capital early on. Probably weren't quite at that inflection point. You know, the reason that private equity and venture capital love this business, you know, franchisees fund your growth. Royalties are a beautiful thing. It's kind of, you know, SaaS-like revenue. The alignment is beautiful in this industry, and margins at scale can be great, like a software business. But it's going to take you a while to get to all of those points along the way. It's you know, usually that's somewhere around 50, 75 units opened at maturity, you know, before you're even getting to that point. We've started smaller where we're comfortable, where we feel like we have a reason to invest, but you know, generally that's a good rule of thumb, and you know, trades usually happen closer to the single digits than the double digits, but the more scale you have, the more checks on the boxes that I just described you have, the healthier you're growing, the more likely you'll be to be able to generate, you know, a 20x exit down the road. But, you know, don't start with that end in mind, because I think it's a recipe for setting yourself up for disappointment.
Yeah, I'm dating myself, but Ron and I were on a panel probably 10 years ago, and you didn't throw out 25 times, you threw out like 15 times back then. So multiples have definitely expanded. But the analogy I'll give you guys is this. Let's just say you're a fitness franchisor, just throwing it out there. And let's say you hear that, a fitness franchisor is just bought by Roark Capital for 25 times EBITDA. That does not mean that you are worth 25 times EBITDA, okay? Like, just because you're a fitness franchisor and another fitness franchisor got that multiple, it doesn't mean that that is the multiple for your industry and for the fitness franchising world. That would be like the quarterback at Kent State getting the same contract as Tom Brady. It's two totally different things. And so do not apply the high watermark valuation in your sector to you. You have to build yourself up to become a best-in-class operator with the data, with the scale, with the cash flow, with the franchisee level profitability to get that high watermark valuation. So there's a lot of generalities and around what are multiples these days, and people throw out the high watermarks because those were the best-in-class operators that were able to earn that valuation. For an emerging brand, just because somebody in your sector got that, you've got to earn your way to get there. It doesn't mean that somebody is going to place that valuation multiple on you today.
That's why I love having him on panel. He's a banker, and he's telling you the truth. That's just question in the back.
Yes, sir. The gentleman mentioned about 50 to 75 units once at maturity.
Yeah.
What does maturity mean? Once the franchisee has reached ROI?
Yeah, that's one way. I think about it as the franchisee's been operating in the ground for at least a year, 18 months, something like that. So, generally they're hopefully making money. They're no longer in the red.
That
So
also
that's why-
depends on the size of the investment and whether it's a membership-based business that
Correct.
takes 2 years to scale
Yeah.
versus a restaurant where your best month in the first year is the first month you're open.
Yeah.
Because you did a grand opening, so. You had another question?
Thank you. Regarding the multiples, so obviously in franchising, the high number is at, 25, which is.
That was just for shock value. That was just for shock value.
Within franchising, though, you have restaurants, you have fitness brands, you have home service. Where do they fit in that scale? Like is home service, on the upper side, upper end?
Yeah, John could probably tell you to a T where all the cohorts sit, but
I just
know,
want to
Dave-
throw one thing in. The new word in franchising is platforms. And you'll get a higher valuation if you're a bolt-on to a platform because they're going to suck up all the G&A in the platform. So
Yeah.
you'll get more money. I don't know how that goes into multiples, though.
John, I don't know if you want to comment on, I don't know that I could say like,
Yeah.
fitness franchisors
Yeah,
trade
look,
in this band, home services.
I mean,
trade in
I would
this.
say that you have premium valuations in all of those sectors that you mentioned. There are certain sectors that will be fall in and out of favor. Just based on secular trends, consumer trends, things of that nature. I mean, the restaurant industry, candidly, is more difficult to. There are not a lot of premium valuations today. But the thing I would tell you is that all of those every category within franchising can there are premium multiples out there. The thing that you need to think about and what really produces that multiple is what is the growth trajectory of that business, and how much confidence does the buyer or the investor have in that growth coming to reality. And so, if you're 100 units and you have a total addressable market, and and investors have done a lot, market studies and spent a bunch of money on diligence, and they think that you can put 2,000 units comfortably in the country, then they'll pay a high multiple for that because there's you know, exponential growth potential there. And so, but if you're a mature brand and you've sold out all your territories and your franchisees are growing at 5% a year, and you're like, man, you know, maybe I need to go into Canada or the UK, but I don't really have a ton of white space in the US, then there's not a lot of additional growth for that buyer to generate value, and so it's going to be priced at a lower multiple.
Yeah, but if you don't have any white space left and you're not making a lot of money and flying private, then you did something wrong, right?
Right.
The U.S. is big enough that you should be able to do that. And with that, we have one more question, then we're out of time. You've had your hand up for.
Yeah.
Go ahead.
So, quick question. You mentioned before, in terms of when you first open up a bunch of stores, capital investors want to see data over time to show that they are self-sufficient and successful. What is the average amount of data and, I guess, time span that you're looking for to have that?
I mean, it's different for different brands, but you know, I would say you want the majority of your franchisees to have been open at least a year. You know, I mean, like I've looked at a lot of emerging brands, and you know, the founder thinks that they're ready, and I've told them to wait because, you know, 70-80% in some cases of their franchisees that are in the ground and generating royalties for them have only been open a year. And so, you know, there's just, you can't assign a confident level of risk to that franchise system yet. Now, it's not to say that if you get a bunch of your franchisees in the ground, they've been open 2 or 3 years and you're still growing and you're still open, you know, say you're open 100 units a year, we can create ways to get you value for those 100 units that are new as a high growing franchisor. But you have to have a stable base of franchisees that have been somewhat seasoned, and you can look at the data and tell that they're, you know, committed to being a part of the brand long term and fulfilling their, you know, their full obligations under the franchise agreement.
I'll leave you with one other qualitative thing that everyone looks at. And as you grow into the growth stage as opposed to the startup and emerging, how many of your units that open each year are opened by existing franchisees versus first-time franchisees?
That's a really good one.
Because the only reason you're opening a second unit is because you're making money in the first one. So that is something we look at over and over, and a very large restaurant chain just got a huge valuation, and that's because 70% of their new unit openings were with existing franchisees. So, thank you all. Hope this was valuable to you. Thanks to the panelists.